Welcome to the Roy Matlock Jr. Money and Business Hour. Reach Roy at 615-843-2999 or visit roymatlockjr.com. And now, here's Roy.
We are getting rolling here, and this is the Procrastination Show. So if you are a procrastinator, you need to listen up today, because we're going to not let 2025 pass you by, and we're going to get the procrastination over with and automate, accumulate, protect your money, get your money moving. That's what we do. We do this every weekend, and we put these shows out with the intention of getting you good information so you can make good decisions. And I believe this: if I'm given the right information, I can make decisions. I think most people can too when it comes to your money. And so we're going to talk about this, but I did some research, and I went in and I said, what is procrastination? It says it's the act of delaying or postponing important tasks, often replacing them with easier or less urgent tasks. In money terms, it's the failure to act on financial decision when the cost of waiting is much higher than doing something. So we call in investing the high cost of waiting. We talk about missing compounding periods, and I'm going to be talking about this today, about all about procrastination. So if you're listening right now, you need to just tune in here. If you have been putting off doing things, just remember this: procrastination costs you money. Not making a decision is a decision. I always tell people, if you have your money in the bank, that's a decision. If you have your money in a stock that you say, well, I wouldn't buy it now. Well, you're buying it. All right. And not making a decision is usually the most expensive one. So we got to learn how to act. I read a book years ago from Stephen Covey. It's called The 7 Habits of Highly Effective People, Successful People. And he had these 4 quadrants. He said there's quadrant 1, which is urgent and important, and that is crisis, pressing problems. You got no choice. You got to make an act. You got to make a decision. So quadrant 2 is not urgent but important, and that is the key to getting ahead. What is not urgent but important? It's goal setting, it's planning, it's thinking. My dad used to say this, why most people don't think. They don't think because thinking is hard work. The 3rd quadrant is urgent but not important, and those are things, just time wasters. And then the last one is what is called not urgent and not important. So let's think through this. So important things we need to take care of. By lack of planning, we are forced into urgency. All right. And that means that you're behind on your money. You hadn't been starting early. You didn't do all the things you got to do. Now you got to really just buckle down and do it. And you may be in that situation. It is now reality time. You have waited and you didn't get started, or you are doing the things that you should be doing, which is thinking, planning, doing that stuff, creating your GPS, goal, plan, schedule, and putting things in place so you can get into what I call quality of life zone. So the quality of life zone works like this: if your income is here and your outgo is below and there's a gap in between, generally speaking, you have a pretty good quality of life. If it's the other way around, your outgo is more than your income, then you're probably not a happy camper right then. And a lot of that has to do with planning and making things happen and getting started. And so procrastination, number 1 wealth killer. Most people don't fail financially because of bad investments. Sometimes they do. They generally fail because they never get started. It's the most expensive habit you can ever have when it comes to your money and pretty much anything. So if you're a procrastinator, it is costing you money right now. Today, it is costing you money. If you wait a month, it costs you money. If you wait a year. So why does it destroy more wealth than bad markets? Well, because here's what happens. Good intentions, that's what people have. Implementation is the key. Systems are the key to it. When I first got started, the key element if I go back in time and say, what is the number 1 thing that caused me to have money? It was called a bank draft on my checking account into investments. And back in 1985, I got my securities license and I learned about mutual funds. And the first thing I did was I set up a $50 a month mutual fund draft. $50 a month. And at the time, 1985, that was, not a lot of money, I guess, but it was a lot of money to me. And I had $100 a month going into a draft, into a money market account. That was my emergency fund. I automated that. We are now 40 years into automations. I don't worry about things because of my automations. My automations are I have all my bills going out. I have all my bills to me going out. That's my investment accounts going out. And so what happens is we have automations that we can put in place. The most important thing is to create a system that will allow you to win. What is the system? Auto savings, auto 401k, auto bill pay, a a system. Wealth is built by habits, not by hoping. You're not going to get financially independent by hoping to get financial independence. So, what we're going to do is we're going to start working on stopping the procrastination. So, it's right now, I'm doing this show. It's almost September 2025. We don't want to go another week or another month without getting going. So, let me give you an example. If you wait 10 years to invest $500 a month, here's what it's going to cost you. At 10%, your money doubles every 7 years. So here's what happens. You put 500 a month away at 10%. In 10 years, you have 120,000 bucks. Well, if you miss that, then what's going to happen is the 120 is not there, which is going to double in 7 years, which is 240, which will double again in 7 years, which is 480, which will double again in 7 years, which is 960. So we start looking at our missed doubling periods. So what we want to do is we want to stop delaying, stop procrastinating. That's the show today. I'm going to talk to you about that. If you delay on the defense, your insurance premiums are higher. Usually, in many cases, you become uninsurable. Someday never mentality never happens. We got to get going. We got to get moving. We got to make it happen. And we don't want to let 2025 slip away like maybe it did last year and the year before. So we want to set up one automation. If we do nothing more than get one automation going towards savings and investments, get our insurance in place. So that way, if anything happens, okay, we're not sitting there in trouble. That's what it's all about. And so I want to encourage you to do two things. Visit roymatlockjr.com or call us at 615-843-2999. One of our reps will meet with you, get you started, get you moving. And also our educational seminars, the second Saturday of every month via the web. Tune into that. We'll be right back.
Here's your host, Roy.
All right, we are back for all of you procrastinators. This is your show. You're a money procrastinator. Do you have a sign on your head that says, I'm not saving any money right now, and every day I'm not saving any money. I feel bad. All right, and I want to fix that. I want to get my finances fixed once and for all. We did a seminar years ago called Fix Your Finances. I think it was 2020. And the whole idea was get it fixed, take care of it. Let's make it happen. So if you're just tuning in, we started out with the mindset of systems, processes. I meet with people. I had a meeting yesterday and with a lady, and I told her, I said, look, I am an implementer. I'm a financial implementer. We will implement and take that worry off the table. We'll put a plan in place. We will automate the plan, implement the plan, review the plan. And guess what? When it's all said and done, you're going to have one less worry that you have to deal with because you took care of it. You stopped the procrastination. So if you would like help, we are a fiduciary. We are not tied to any one company, and we set up plans. And I love working with, and our guys love working with people that are just getting started too. If you've got $500 a month or $300 a month, call us. We'll get you something going. And then that way you can say, not another day has passed that I don't have something going. I'm on my way. I'm going to get started. Segment 2, we're going to talk about the buckets. What are the buckets? The buckets are we earn our money. Where are we going to put it? All right. What kind of bucket is it going to go into? And so what we need to know about buckets are this. If it's easily accessible, it's probably taxable. If it's easily accessible, it's probably taxable. If it's not easily accessible, it's probably got some tax benefit tied to it. So that means 59 and a half, you get tax deferral, or you maybe get tax-free income on a Roth, whatever it may be. If you have easily accessible money, then it's probably going to be taxed. One of the rules that we try to live by is never pay taxes on money we're not currently using. And the reason is that we're having to work every year to pay taxes on that money. So what we want to do is we want to have a couple of accounts set up. The first bucket is taxable and liquid. What are they? An emergency fund. We do that 3 to 6 months of expenses. It's in a money market account, things like that. Why do we do that? That allows us to save money on our insurance products. So if we have 15,000 bucks sitting in the bank, in a money market, not in the bank, but if we got it banked, I like money market funds. But if we have that, we can raise our deductibles on our car insurance. We can raise our deductibles on our homeowners insurance. We can lengthen the waiting period on our disability income and the deductibles on our health insurance if we're buying it. We can set aside, monies to be able to withstand any type of emergency, so we don't dig in and start creating credit card debt. So all these kind of things are designed. That's why we have this money sitting there at 4%. It's not getting 4% in a money market. It's getting maybe 15 or 20% when you take into account all the different things that it allows you to do. And it keeps you from paying penalties in the event you have an emergency. You're not paying penalties on your retirement plans and taxes and all that kind of stuff. So we have a bucket, all these buckets. We're going to go through these different money buckets, taxable and liquid. We also have what I call opportunity money. Opportunity money might be in a balance fund. I can give you stories of clients of mine that we said, we're going to put X amount of dollars into an opportunity account. We don't have it earmarked for anything, especially, right now, but we want to have access to it. We want it to grow. So stock and bond funds, something like that. And then one day an opportunity pops up. Maybe you can buy a business, or maybe you can, buy a partner out. We had that situation happen where he was able to buy his partner out. And in doing that, it was the return on that opportunity money was like 100% return. I mean, it was unbelievable. I always believe this, that if you're a business owner and you're good at what you do, you can get great returns on your investment, all right, by putting it into your business. And then we have a second bucket of money, which is our passive income bucket. That's what I help people with on their passive income bucket. But the bottom line is that if it's taxable and liquid, all right, it's going to be taxable and liquid, or it's going to be tied up and not liquid, and it's probably going to get tax benefits. So what do we do? So what we want to do is want to remember one thing. If we take our retirement money out today, we're not going to have it later. So our first bucket is an emergency fund and an opportunity fund that we're going to have for our accessible money. Now, it's not the only bucket. It's one of the buckets. It's taxed and liquid. And so liquidity usually is lower returns, but not always. All right. So what happens if you don't do this? Let's say you procrastinate. You're a procrastinator. You got that sign on your forehead. I'm procrastinating. It's costing me money every day. It's costing me money to procrastinate. That's what I am. I'm a procrastinator on my money. Well, you don't have an emergency fund. Every repair on your car or your medical bill comes up, and it's a total crisis. You think you've got like problems. You don't really have problems. You got a situation. Your situation is you don't have an emergency fund. A problem is you get diagnosed with something. All right. This is just a situation that can be fixed. You're relying on credit cards then in order to be able to fix it. Okay. Well, now you're paying 20% interest to fix the fact that you didn't take care of your business. All right. You miss out on early taxable investing. So you lose out on your compounding because you didn't get yourself going. You didn't fix your stuff. And so that's what we're doing. So let's get moving. That's what we got to do. We got to get moving. No more excuses, no more procrastination. It's almost another year has passed reach out to us and we'll be happy to help you. We do a phone call to start with. That's easy. And you can visit roymatlockjr.com and schedule a call to be able to get it fixed. So the second bucket, we're going to start with that. That's tax deferred and tax free. So if your liquid money is for today, retirement accounts are for tomorrow. And Uncle Sam will give you some powerful incentives to do that. So there's all these different ways that we can use the IRS to help us. All right. So let me give you some thoughts on this. If your electric bill was double and you could cut it in half just by making a few adjustments, would you just keep paying double on your electric? Would you keep paying double on your water? If your car payment that you've got, you say, man, I like paying $300 a month. No, I'd rather pay $600 on it. But when it comes to taxes, people, I see it all the time. Almost every time I meet with someone, I'm going to give it 8 out of 10 times that I meet with someone, I can show them a way to save taxes just by taking advantage of simple little things. All right. And get their tax plan going. You got tax deferral and you got tax free, you got tax deductible. So let's look at this. Tax deduction means when you put the money in, you get a deduction. So if you put in 10,000 into something and it's a 25% bracket you're in, you save $2,500. That $2,500 you can leave that now that would have been going to the IRS and in the IRS's coffers, it's in yours and it grows from there. You can get tax deferred. Tax deferred means you don't pay it now. You let the money sit that would have gone to the IRS and it grows. You can let that defer forever. You can let it defer forever. All right. And you've also got tax free where it grows tax free and you never have to pay taxes on it. So what we're going to do when we come back from the break, I'm going to get into all the different ways that you can cut your taxes. And it's not that hard. It's just a matter of implementing. So here's what I know. Setting up a Roth IRA, that gives you tax-free income. How do you do that? Well, that's what we do. Well, you don't put it off. We don't procrastinate doing this. I'm going to talk procrastination all show today because I know that's the big problem. My name is Roy Matlock Jr. If you are listening, visit roymatlockjr.com and we will help you get started. We'll be right back.
Visit roymatlockjr.com. Now, here's your host, Roy.
All right, and we are going into segment 3. I want to encourage you to go to roymatlockjr.com. We are doing a webinar series, and we do it the second Saturday of every month, and we pick out different topics. In these topics, you can find that out, and once you sign up once, you'll be getting something via email to let you register. We also do replay links on all of those. So that would be something you might want to do, but we're doing it that way. You can see a live webinar. It's 90 minutes. We typically have about 4 or 5 of our advisors take short parts. I will be opening and closing that. And also you can be looking for our stream. We're going to be putting that out where you can see live stream where you can kind of see what's going on rather than just hear, the radio. People used to say to me, my buddies would say, yeah, man, you got a radio face. I said, no, it's a radio voice. They said, no, it's a radio face. Well, now you get to see the face and the everything that goes along with it. But anyway, so we're going to go back into tax deferred and tax-free buckets. So let's talk about it. The IRS is saying we have some rules. If you'd like to participate, we will allow you to defer your taxes. We'll allow you to have money that grows tax-free. Or if you would choose to pay it, you rather would pay us today, and have no use of that money, then you're welcome to keep doing what you're doing. Let me give you some examples of things that you can do right off the bat. I see people, did you get a tax refund? Oh, yeah, you did. Well, that's good. Did you happen to pay the H&R Block to get you your tax refund so you can get it quicker? Yeah. I know people that do that when all you have to do is raise your exemptions to where you have it paid to you monthly. How about that? And so rather than having a $4,000 tax refund, you get it immediately. You take the $333 a month, and we have it drafted out of your checking account into a Roth IRA. And now not only did you get the money now, it grew and it goes into something tax-free. So it's just a lot of stuff. I see it all the time. I see people making money and they're not doing it. So what are some of the tax deferred and tax-free buckets? You can do a 401k or a 403b if you like work for a nonprofit or a hospital. 401k is for a typical company. Pre-tax, you get tax deferral on it, and you get employer matched. All right. So how about that? So free money. So let's think through this. We put in 6%. They may give you 3%. That's 9%. You deduct the 6%. It only costs you 5% to invest it. So now what you got is you put in 5 and you got 9. That's pretty cool. I like that plan. You can put up to $30,500 if you're over 50 into one of those. Get a tax deduction. I see people do only the match when they have the ability to do other things. Now, we're not going to tell you only do the match or do all of it, but if you have the ability to get the big full contribution, put in 30, maybe you save $7,500. That's 7,500 because you're in the 25% bracket. That frees you up. That money could go into a Roth IRA or a backdoor Roth IRA. So now what we're getting is we're getting employee match, pre-tax, tax deferred. We can do a traditional IRA. That's tax deductible now, tax later. We can do a Roth or a Roth 401k. That's after tax. We pay the tax now, but we get tax-free growth. Who do I recommend do that? For sure, younger people when they have a long time to accumulate money. Sometime when you are at or near retirement, I see people that are behind. And if you're behind on savings, and how do you know if you're behind? That means that when you quit work, your RMDs that you would pull from a traditional retirement account are going to be less than what you're making. So your income's going to go down. So you're not way ahead. But maybe your income is up right now because you have been doing what you've been doing. You started a little late. Well, we might tell you to put it into a pre-tax investment, save the taxes when you may be at a higher tax bracket, put the difference into a tax-free account, do something like that. So when we meet with people, we make decisions, what makes best sense. Should you do a Roth? Should you do a traditional? But should you put it into just the matching accounts because your matching funds are sitting there and maybe you don't have a lot of great options and you're better off doing it elsewhere? Or you may have one of those 401ks that you left at a previous job. I can tell you horror stories about 401ks that people forgot about and then come to find out they've been there for 10 years or more, and they've been in fixed accounts, or maybe they've been in bonds when bonds were at an all-time low interest rate, stuff like that, not invested. Or if they were invested in something, they had it in poor returns. When you have the ability to roll those over into a retirement account, and you can go, for instance, with a fiduciary that has the Amazon of all products. I mean, what we do is we clear through a big clearing firm. I'm not going to mention that name, but it's the biggest one out there. And they have over 9,000 choices. It's like opening an Amazon account. You can buy anything. Same in the investment world. We do the same thing on insurance products. And so what happens is you've got that 401k sitting out there you forgot about. Well, it's costing you money. Procrastination costs you money if it's not in the right place, if you hadn't got it optimized into doing what you're doing. So anyway, we got that. We have annuities. Annuities, you got different types. You got fixed annuities, you got indexed annuities, you got something called a registered linked index to index linked annuity. That's a RILA. We have variable annuities. But the long and short of an annuity, what is an annuity? It's an insurance company that ties some investments to it, and they give you some guarantees. So what kind of guarantees? Well, if you have a fixed annuity, you're going to get principal guarantees and tax deferral. If you have an indexed annuity, you're going to have partial guarantee. You have principal guarantees and partial upside of the stock market. If you have a RILA, you might have a product that's 6 years. You invest it, and if the market's down 10 to 20%, depending on what you choose, you will have protection against market losses up to a certain level. You have variable annuities that gives you all the up and all the down when it comes to investments, but it allows you to get tax deferred growth as well as lifetime income guarantees. Some of them even have long-term care benefits to go along with this. So annuities have a place in your financial plan, and they fall in the tax deferred bucket. So what we're doing is we're creating a system, all right, for our money. And when we close out today, I'm going to talk about all the different income streams that you could possibly have. And I ask people this: if given a choice, you only have one retirement income stream, meaning Social Security. Would you rather have two? Would you rather have three? Would you rather have four? Would you rather have 10? I would rather have a bunch of different income streams to help me move in the right direction. So here's what we do: compounding plus tax savings equals exponential wealth building. Now, let's talk about procrastinators. All right, you're a procrastinator. That's what you are right now. You're procrastinating, you hadn't done anything. If I'm bothering you right now, you need to just realize it's costing you money. I'm trying to help you here. Miss an employer match, leaving free money on the table. That's what the cost of doing nothing. Delaying loses a period of compounding. So let's say you've got $400,000 and you could have had put it in 7 years early and had 800,000. That's a pretty big cost. You're retiring with only Social Security, which gives you a very limited lifestyle because you just didn't do anything, right? So what happens is the cost of not doing it, again, when we talked about at the beginning of our first segment, the first segment is about implementation. Great intentions, poor follow through. What we do for people, what I do for people is when you get through with us, guess what? It's implemented. We put it in place, make it happen. The things you need to do, we follow through and we implement plans of action to get you going, a goal, a plan, a schedule to get you on track. So let's get it going. Let's make it happen. That's what we do. Visit RoyMatlockJr.com, schedule a free call, or call us at 615-843-2999. Let's get on track. Let's get it going. We'll be right back.
Visit RoyMatlockJr.com. Now, here's your host, Roy.
All right, we are back, and the final segment today, and this is the procrastinators show. So if I'm getting under your skin, it could be because you're a procrastinator. And what we're going to do is get you going in the right direction. And so far, we've talked about, the plan is the most important part. We help you implement plans. It's kind of like getting a personal trainer, you'd have to be pretty bad if you go pay a personal trainer and the guy shows up at 8 o'clock in the morning and you no show. All right. You'd be like, man, I'm hiring somebody to help me do something. And that's what we do. People hire us to make sure that their plan gets in place. And we take the procrastination and we put it into implementation when it comes to your money. So let's talk about a couple other things that go along. I talked about an emergency fund, why you get it. Then we go in and we create defenses to kind of protect all of our offense. And so I'm going to talk quickly about the defense, and then we're going to talk about all the different income streams you can have to be able to have a secure and comfortable retirement. And here's the other side about it. When you do something and you implement something, here's what you're going to, I can't tell you how many of my clients that they just tell me, man, I've accumulated this much more money. I've done this. And they start focusing on it because we have a plan. I set one up yesterday, had a new client, and we have $1,500 a month going into an automatic draft. All right. Now I want you to think about that. $1,500 a month. You know what they have to do? Nothing. All they got to do is just have the money in the checking account. I tell people it's a real simple system. You have it in your checking. We move it out of your checking. We put it into an investment, and you're on the way. How about that? It's pretty simple. And we'll set that all up for you. All you have to do is just have the money in the bank account. Isn't that interesting? I mean, that's a great concept. Have it in your account, which it is already. More than likely, your payroll got direct deposited. And what we're going to do is just snatch it right out, put it into something. So take it from your low interest, move it into something that gets a better rate of return for your benefit. And guess what? Life gets better. That's the way we operate. It's implementing plans. That's what you want to do. No more procrastination. It's not, we're almost 9 months. Okay. Completed. I mean, hey, we're going into the 9th month when you're listening to this show. So you can't play offense without a defense. One big financial hit on illness and accidental lawsuit can wipe out years of growth if you're not protected. So I'm going to give you some things that we want to do. Number one, budget is the first step to setting up a good plan. If you don't have money to invest, here's the quick idea on your budget. Go to RoyMatlockJr.com, download our budget form. Then once you do that, you go through and you say, well, I made $100,000 last year. I'm going to fire all my expenses, and then I'm going to add them back into my budget. I'm going to look at all the ones that I say, well, if I didn't have them now, would I take them on? Can I get out of that? If I can now, I'm going to do it. I'm going to fire those expenses that I don't have to do. And then I'm going to create a gap that allows me to save money. So that's how it is. Some of them you can't get out of immediately. You buy a house, it's too expensive. Maybe you can't get out of that right now. But maybe you bought a car that's too expensive. Maybe you can get out of that. That was one of my big deals. I had over $600 of car payments back in the 80s. And I finally got out from being upside down. And it was I think $637 a month that I was paying in car payments. I bought 2 junkers that were paid for. And I put a draft into mutual funds, $637 a month. And that was when everything started happening. Our defense line, we buy life insurance. What kind of life insurance do we buy? We buy 2 types. We buy one in case we die, term insurance for a period of time, low cost, big value, the lowest cost coverage you can purchase to protect your income. And then we buy permanent coverages. I'm beginning to like a lot of these different products. Used to, I told people never buy that stuff. I disagree now. There's different ones. There's called indexed universal life insurance or variable life insurance. One is a stock market cash value. The other one is stock indexes. But both of those allow tax-free growth, tax-free withdrawals, and a benefit that will stay with you for as long as you live. And that's for when you die, not if you die. If you die is term. When you die, you have something permanent. One of the things that happens if you're married, you lose the Social Security right off the bat if something happens to one of the spouses, and you have a cleanup fund, or maybe you want to set up some kind of legacy. So we do that. We buy health insurance because medical bankruptcies happen. People go bankrupt over no health insurance. Absolutely no reason to do that. You can buy health share plans. You can buy high deductible plans that allow you to, $7,500 deductible or something like that. So if you have a big claim, you're not being wiped out. You buy disability income, protects your paycheck. I think even worse than dying would be to not be able to work and have no money. You can do that. You can buy partial disability policies based on if you've saved some money and so on. We go to property and casualty. Tell you story after story after story on that. That's home, auto, personal liability coverage. If you have businesses, it would be business umbrella policies as well. What does property and casualty mean? Well, if you tear your property up or somebody does, you've got insurance to protect that. So we basically buy insurance to protect our income or our assets. That's what we do. If we look at life insurance, it's to protect income. If we look at health insurance, it's to protect assets. If we buy disability insurance, it's to protect income. If we buy property and casualty, it's to protect our assets so we don't get sued. And we protect our car, home, and all those different things like that. We buy personal umbrella policies to protect against lawsuits, which are basically asset protection. So we're going to buy all of that kind of stuff. And I can assure you on this that there's a lot of pricing differentials out there. There's a lot of coverage differentials. And what we would be happy to do, we have what's called a marketplace for insurance. And we have access to everything I just spoke to you about. And we would be happy to do a review. And generally speaking, we can answer a question for you. And that question is, when you have a claim, you'll know you're covered. All right. That's the key to it. I have people all the time say, well, is your insurance paying? What do you mean? You're paying thousands of dollars a year and you don't know? Well, when you get through having a review with us on the insurance side, we will make sure that you have all of the things in place once again to take that portion of your life of worry when it comes to money or worries off the table. Reach out to us. We can help you on that. So now we're going to develop income streams on the back end from all of this planning. We're developing income streams to become bulletproof. Bulletproof means that, maybe it's called diversification. It means that, we've got something good happening no matter what. If you owned a business and you're on the beach and you were selling sunglasses, what happens when it's raining? People aren't buying sunglasses when it's raining, so we sell umbrellas. We have 2 products, one for the good times, one for the bad times, whatever it may be, and we do the same thing. So let's talk about it. One thing you can do, you can work longer or have a part-time income in retirement, do something you like, maybe one of your hobbies, that you like to do. I know people that work at the golf course and they work at the golf course so they can play golf for free and make money. You got Social Security, you got pensions. You have to choose what you're going to do on your pension. Do you take it in a lump sum? Do you take it individual life or a joint life? You have annuities. Annuities, there could be lifetime income guarantees, things that protect you in the event you go in a nursing home. You got life insurance policies. We talked about cash values. You can pull cash value out through policy loans or withdrawals for retirement supplements, and they're tax-free when you do it as a loan. Then you got your retirement plan at work, your 401k, which eventually becomes an IRA. You've got traditional and Roth IRAs. You've got, if you're self-employed, you might have a SEP or a simple plan or a solo 401k. All of these things are income streams. We've got health savings accounts where we can put money in and deduct it and pull it out tax-free once you're 50, after age 59 and a half. It's like an extra retirement plan. So you can use it for medical expenses early on and pull it out tax-free as a retirement plan and get a tax deduction, putting it in. All of these are income streams that you can create. You can own a business. You could take that business and sell a piece of it and maintain part of it. You could consult in the business. You could own your own company. You could have an entity that lasts forever and ever and ever. I think Starbucks, the guy that started that's probably going to continue to get paid. I bet his family will get paid long after he's gone. He built a system, an entity. You've got business succession plans. If you own a small business, you can do a lump sum or an income stream from selling or transferring a business. You got royalties. I mean, I'm going on and on from intellectual property. You got franchises, you got brokerage accounts, you got real estate rentals, you got all these different things. We got other places to get money to retire on. We can maybe we get an inheritance. Maybe we do a reverse mortgage. I can go on and on and on and on and on. But what would it be like if you knew you had all these different income streams that would allow you to do things? How do you get those income streams? Well, I can tell you the way you do it is you implement them. All right. That's what you do. The only one that gets automatically implemented from working is Social Security. Everything after that generally doesn't happen. You might be with an old time pension. All right. Maybe you're in a union, or maybe you work at a police department or something like that. But most of the time, those things are going away. So it's up to you. You have to do it. You have to make it happen. You have to pay the price. You have to put the money in the account. You have to get it automated. You have to do that stuff. That's what happens. And if you're not doing it, it's your fault. It's your fault you're not doing it, because there's too much access to being able to do things. I'm jumping on people today. I'm kind of kicking you in the butt a little bit. And the idea behind it is there's absolutely no reason that you should not become financially independent. Procrastination. This is the show. Today is the procrastinator show. If you have not done anything, or you're not doing everything you need to be doing, if you heard something, you need to call us. Go visit roymatlockjr.com and, hey, listen to the podcast. We put a search item in there on the podcast that allows you to be able to search any topic and find out about it. Sign up for our webinars, set up a free phone call. That's what we do. And if you're a business owner, we have all kinds of plans to help you do that as well. My name is Roy Matlock Jr. I hope you enjoyed the show. We'll talk to you next week.